So what if I told you that there was an optimal allocation between Australian and international shares such that you could minimize your risk, but at the same time maximize your returns? Well, in today's video, we're going to be looking at the historical returns of the managed fund versions of VAS and VGS to answer this age-old question that probably every Australian investor has had before. But before we get into the data, let's briefly talk about VAS and VGS. Now, these two ETFs combined make a very popular investment portfolio that many Australian investors follow. And that's because between the two of them, you pretty much get exposure to all developed markets around the world. With VAS, you get exposure to the top 300 companies in Australia, and with VGS, you get exposure to 1,500 companies across all developed markets around the world, excluding Australia. And on top of that, the expense ratios, so the fees that you would pay to invest into these ETFs, are extremely low as well. So with VAS, you'd be paying 0.07% per annum and VGS 0.18% per annum. I've made a pretty in-depth video talking about this particular portfolio, so you can check that out if you are interested, but let's get into the data now. So using the historical data from the real returns of the managed fund versions of VAS and VGS, when we plot the performance between 2009 and 2019, using the efficient frontier method, we get this graph. Now, what you see on this graph is the various different portfolio allocations between VAS and VGS. Each of the dots that you see on the graph here represents a different portfolio allocation. And it essentially aims to tell us the optimal portfolio that balances both returns and risk. On the x-axis, you have the standard deviation, which essentially can be interpreted as risk. So the more right you go, the more riskier the portfolio. And on the y-axis, we have the mean, which essentially represents the performance or the returns of the portfolio. So the higher up the y-axis we go, the higher the returns of that portfolio. So based on the chart, what it is essentially telling us is that between the time period of 2009 to 2019, international shares outperformed Australian shares. And that's because if we took a portfolio that was comprised of 100% international shares, then that would have given us the highest returns. Whilst on the other hand, if we took a portfolio that was 100% made up of Australian shares, it not only would have given us the lowest returns, but also the highest amount of risk as well. Now, both of these portfolios are actually suboptimal because it's either not giving us enough returns for the amount of risk that we're taking on, or we're taking on too much risk for the amount of returns that we're getting. And so the optimal portfolio that balances both risk and return is made up of 55% international shares and 45% Australian shares. Now, if you look at the performance of VAS and VGS over a different time period, so between 1999 and 2009, we can see that the optimal portfolio is still comprised of 45% Australian shares and 55% international shares, except this time the Australian share market has outperformed the international share market. And finally, if we go even further and look at the performance between 1997 and 2022, then Australia still outperformed the international share market, except this time the optimal portfolio allocation has decreased down to 40% Australian and 60% international. Now, the claim that the Australian share market outperformed the rest of the world is also backed up by research that was done by Credit Suisse, where they looked at the real annualized equity returns of different countries in its local currency and US dollars between 1900 and 2018. So with all of this information in hand, it seems that an optimal portfolio is comprised of somewhere between 40 to 45% Australian shares and 55 to 60% international shares. Now, if we just ended the video there, it would be perfectly fine to use that portfolio allocation moving forward. However, one important factor that we haven't included into our analysis is franking credits, and this potentially has a real impact on our overall findings. So just to level set everyone on franking credits, Australian companies that pay Australian tax can essentially issue franking credits to Australian investors that acts as an offset to the tax that has already been paid by the company, so investors aren't taxed twice. And these franking credits can typically boost the overall returns of the S&P/ASX 200 index by roughly 1.5% per annum. So if we look back at the research that was conducted by Credit Suisse, this was actually done on the real returns of both the capital and dividend growth. So it didn't actually take into consideration the benefits of franking credits, which would have meant that the difference in performance between the United States and Australia would have widened even further had we have considered franking credits. So I guess the question is, if we take into consideration franking credits, does that change the optimal portfolio allocation? Well, luckily for us, Morningstar actually have done this analysis. And it's unsurprising that when we include franking credits into the equation, the optimal portfolio allocation with Australian shares actually increases. So for a reasonable range of risk, when we do include franking credits, the optimal allocation of Australian shares is around that 45% mark. So it's not that drastically different to the conclusion that we talked about before. However, it does make the argument stronger for the optimal allocation to be more heavily weighted towards that 45% mark rather than the 40% mark. If we excluded franking credits from the equation, then the optimal allocation drops to around about that 40% mark. And as the investor's risk tolerance increases, then the allocation towards the Australian share market could actually decrease to as low as 10%. Essentially, the higher the risk appetite of the investor, the lower the allocation towards the Australian share market when we don't take into consideration franking credits. So to conclude, based on all of the data that we've seen today, an optimal portfolio that is comprised of VAS and VGS would be somewhere around 45% for VAS and 55% for VGS. Now, so far we've looked at things purely from a numbers perspective, but there are some other elements that you might want to take into consideration when figuring out what your portfolio allocation is. And the first one is the tax advantages and disadvantages to investing into the Australian share market. Now, what I mean by that is that when we change our allocation of Australian shares, there are inherent advantages such as franking credits and also inherent disadvantages as well, such as having to pay taxes on a relatively higher distribution yield. For example, if you were a relatively high income earner in the highest tax bracket, having a portfolio that's more heavily weighted towards the Australian share market might not be the most tax efficient, because then you're essentially paying 45% of every dollar that you receive in dividends. On the other hand, if you're retired, then it's probably beneficial for you to have a higher allocation of Australian shares simply due to the benefits of franking credits. So if we take those factors into consideration, the optimal portfolio allocation of Australian shares versus international shares might change depending on where you are in life. If you're starting to invest in your 20s, then it might be a good idea to start with a portfolio allocation of 45-55, but as you go into your 30s and 40s and your earning potential is at its highest, perhaps scale that down to a 40-60 allocation. And then once you hit your 50s and 60s and you're nearing retirement, you'd want to have a higher Australian allocation of 55-50. The second factor to consider is concentration risk. The Australian share market is highly concentrated into the financials and materials sector. So if any adverse events were to happen in those sectors, then our portfolio could be more exposed than we would like it to be. And the third factor is the cost of investing into VAS and VGS. Whilst the news that Vanguard was reducing the fees for VAS down to 0.07%, from 0.1% was great news, the management fee of VGS is still 0.18%, which essentially means it's twice as expensive when compared to VAS. Now, a good way around this is essentially invest into more cost-efficient alternatives. Namely, we could go for the beta shares equivalent of A200 and the newly released BGBL ETF, which comes with a significantly lower management fee for both, whilst also providing similar exposures. The only notable difference is that A200 provides exposure to the top 200 companies, whilst VAS provides exposure to the top 300 companies. However, it is important to note that the extra 100 companies only makes up around 3 to 4% of the total portfolio for VAS. Now, ultimately, it's up to you to determine what portfolio allocation suits you based on your own circumstances. But hopefully Hopefully I've provided you with the insights and the data to be able to make your own informed decision. So if you enjoyed the video or learned something new, make sure to hit that like button and subscribe to the channel for more personal finance related content. And if you are interested in learning more about why a portfolio consisting of VAS and VGS makes such a good portfolio, make sure to check out this video right here.